All right, welcome. Today we're doing more than just talking about managing money. We're actually building a modern playbook for your capital. The real goal here is to build wealth that's going to last, something that's built for today's financial world. So if you're ready to start thinking like a truly sophisticated investor and really put your capital to work, you're in exactly the right place. Okay, let's jump in.
This quote really nails the theme for our whole conversation today. The number one job of your capital is growth. Period. Every single delay, every moment you're sitting on the sidelines, that's a missed opportunity. That's a chance for your capital to be earning returns that you've just lost forever. Our whole strategy has to be about being proactive, not reactive.
And that's a powerful question, isn't it? We usually think of delays as things happening to us, waiting for a deal to come through or for the market to be just right. But honestly, for a lot of people, the biggest drag on their portfolio's performance is internal. It's the cash that's just sitting there, parked in an account, waiting for that perfect moment that might never come.
Now, let's be real. Having a lot of cash on hand is what we'd call a high-quality problem. It's definitely better than the alternative, but it's still a problem. It represents all this untapped potential, and our job today is to solve this cash conundrum and figure out how to make every single dollar work for you.
This is such a crucial mindset shift. We're all conditioned to think of cash as the ultimate safe asset. But when you're in the business of wealth creation, idle cash is a liability. It's a drag on performance. It doesn't grow. It doesn't compound. And as we're about to see, it's silently losing its value every single day. We got to stop seeing it as a safety net and start seeing it as an underperforming member of the team.
So let's put some numbers to this. What is the actual tangible cost of just holding on to cash? Well, the answer isn't on your bank statement. It's in what you don't see, that invisible force that's constantly eating away at your real purchasing power. And that brings us to what I think is the most important metric for any investor, the real return. See, this isn't about the nominal percentage you see on a statement. It's about how much your ability to actually buy stuff has gone up. That's your purchasing power. If your investments aren't beating inflation, then let's be blunt. In real terms, you're getting poorer.
And this little table shows it perfectly. Let's say you earn a 5% return. Feels pretty good, right? But if inflation is humming along at 3%, your real return is only 2%. You've only increased your actual wealth by 2%. And what if inflation was at 6%? Well, then your real return would be negative 1%. You actually lost purchasing power, even though your statement said you made money.
Now check out the scale of this issue. It's staggering. We're talking about over $4.5 trillion just sitting in money market funds. In an inflationary environment, that's trillions of dollars of capital that is almost guaranteed to be losing money in real terms. It is a massive collective opportunity cost. This chart really shows the impact of taking even small steps away from cash. Between 2005 and 2022, Treasury bills, which are basically a cash equivalent, returned about 1.2% a year. But just by taking one small step into short-term corporate bonds, you could have more than doubled that to 2.9%. It just proves you don't have to take huge risks to seriously improve the performance of your safe money.
Okay, so we've laid out the problem with idle cash pretty clearly. Now, let's get to the solution. How are the most sophisticated, high-net-worth investors positioning their capital to avoid this trap and really drive that long-term growth?
Man, this data is so revealing. Just look at this allocation. Public stocks make up about half, which you'd kind of expect, but look closer. The slice for bonds and cash, it's only 10%. Meanwhile, private and alternative assets are almost 3 times that, at 28%. Let me tell you, this is not your grandfather's old 60-40 portfolio anymore. So this gives us a brand new blueprint, a really powerful one. The old 60-40 is shifting to more of a 60-10-30 model. That's 60% in stocks, just 10% in bonds and cash, and a really substantial 30% dedicated to private and alternative investments. This is a framework that's built for today's economy. So, let's zoom in on that critical 30%. Why are these savvy investors putting such a big chunk of their wealth into alternatives? I mean, what are these investments doing for them that traditional stocks and bonds just can't do on their own?
Well, it really boils down to 3 key things. A huge chunk is for generating consistent yield and cash flow from stuff like real estate or private credit. Another big part is targeting that massive growth potential you can find in private equity or venture capital. And then, finally, a smaller piece is for pure diversification, assets like hedge funds or precious metals that kind of zig when the stock market zags.
Now you're probably thinking, okay, a 30% allocation to alternatives sounds great, but that's a lot of capital.
Do I have to sell my stocks to fund all that? And the answer is no, not necessarily. This is where we get into a more advanced strategy, using smarter capital, not just more capital, through something called capital efficiency. And the key to this is a concept called leveraged investing. I know, that word leverage can sound a little scary, but let's reframe it. When it's used thoughtfully, it's not about being reckless. It's a sophisticated tool for making the capital you already have work way harder and more efficiently.
Let's look at a really practical example to see how this works. We're going to compare two ways of investing this same $100,000, the traditional way and the capital-efficient way.
So, option A, the traditional path. You invest your full 100 grand in a standard S&P 500 ETF, and you get 100 grand of market exposure. Simple enough. But now, look at option B. By using a capital-efficient product like a Portfolio Plus ETF, you only need to invest $75,000 to get the exact same $100,000 of market exposure. You just maintained your core position while, poof, freeing up 25 grand.
So what do you do with that unlocked capital? That's your ticket into alternatives. You've hit two birds with one stone. You kept your core stock market exposure, and you've funded your new allocation to things like private equity or real estate, all without having to put in a single new dollar. That is capital efficiency.
So, how do we wrap all this up? Let's take everything we've talked about and boil it down into a clear three-step action plan to help you accelerate your wealth and build a real lasting legacy. It really is this simple. Step 1, put your capital to work. Stop thinking of cash as a resting place. It's a tool that always needs a job. Step 2, explore high-growth opportunities. Systematically build out that 30% allocation to private and alternative assets to add totally new drivers of return. And step 3, build that legacy wealth by using these capital-efficient strategies to amplify everything you're doing and reach your goals way faster.
I think this quote just sums it up perfectly. It's not just about working harder or saving more money. It's about being smarter with the resources you've already got and making every single dollar as productive as it can possibly be.
And I'll just leave you with this one last thought. In the world we live in today, things shift fast. New opportunities pop up and then disappear quicker than ever. So the most important question you have to ask yourself is this: is my capital agile enough, and is it deployed intelligently enough to keep up?